Hello everyone, welcome to the 2024 edition of the Arendt UCITS Webinar Series. The purpose of this series, as some of you may know, is to give our clients some insights on key topics to help them to navigate the new trends in the UCITS fund industry. And today we're going to talk about ESG. I'm here today with some people to support me in this task. So Gaël Guibert, which joined us from Fidelity International. Gaël joined Fidelity in 2022 in the compliance department, but is principally in charge of identifying, analysis, and advising on implementation of regulation and law. And now he's especially focused, on ESG across the world, and on also the topic of CSRD, which is obviously a very big one. Prior to that, Gaël has done 17 years with PwC Luxembourg, and he had some experience also in New York. And he also spent some time with the CSSF as an inspector for MANCO. On the Arendt side, and sorry guys, we will have a shorter presentations, but we have Antoine Portelange, who is an associate in the fund formation team. And Antoine is one of the key elements and very active member of the whole Arendt ESG team. And here on my left, next to me, Valérian, who's a manager in the regulatory practice, but also focusing on ESG only and being a very active member on the Arendt ESG team. Today is actually quite a good day to talk about ESG. We are just the next day after the European elections, and I'm sure we'll have a word about this and see how this may affect the legislative process. But also, it's in the wake of relatively, I would say, deceptive news on ESG and the performance of ESG funds. I think since mid 2023, the market economics have not really played in favor of the funds having ESG strategy. The high inflations, the crisis on oil and market have meant that investors have kind of looked for products that were short-term and providing high values and high return. Underlying projects were affected by the high interest rates, and also some of the values that have performed well, like oil and gas, they were not part of the ESG strategy. So all of these were relatively negative from that point of view. And if we look at the latest Morningstar report, where we see that some of the Article 8 has turned positive on the Q1 2024, which is good news, and maybe we will talk about this. It remains negative for Article 9 funds, and also when we focus on active funds, we see that Article 8 and 9 have really suffered like some relatively large outflow, I believe. Up to 6 billion. So, turning maybe to Antoine and Gaël, which are in the industry and serving clients or as an asset manager, are these figures resonate for you?
Well, they resonate a lot. I think it's pretty much aligned with what we are seeing on the market. So we have gathered our own data based on the funds and sub-funds we have launched, UCITS funds and sub-funds. And what I can say is that we have launched very few Article 9. I think it's around 3% of sub-funds that are Article 9 launched in Q1 2024. 45% of Article 8, and the rest is Article 6. So there is actually a majority of non-ESG funds that we have launched this year, which is definitely not aligned with what we did last year. And another trend that we are seeing a lot on the market is a search for simplification of the wordings of the message we bring to the market, because I think we started with very complex ESG process, complex ESG policies, but nobody really understands what's behind. And now that we have a more important focus from regulators, from investors in terms of compliance with those processes, many asset managers are looking at simplifying to have bottom lines rules that we can easily comply with, and then the message is all different. Less Article 8, less Article 9, and simplified wordings and engagement.
So on our side at Fidelity, our range of ESG funds is still suffering at the moment, but we are slightly positive, more positive on the Article 9 range, probably two drivers is that we didn't launch any Article 9 fund for a very long time, and those are pretty recent at Fidelity and attractive inflows. And also our passive range is quite attractive. And on our side, what we could see also is that one of the indicator that is problematic for those sales is that typically a lot of people don't understand the various shades of ESG methodology, and therefore they focus on performance and fees and just the catchy Article 8 and 9, and that's it.
Thank you, gentlemen. I think we'll have a topic on funds name, so that really well aligned with what you say. I mean, and hopefully, markets are cyclical, and as we've seen before in more traditional market, I think ESG funds have proved to be relatively resilient and attractive. So let's hope the best for the future. So now, before we move to the technical piece, I would like to remind you all that you can have access to the Q&A, and you have also a chat which is available to you. Right, so moving on to the technical piece. So ESMA has published its final reports guidelines on funds names using ESG or sustainability-related terms on the 14th of May 2024. And that was followed up by a CSF communique published on the 15th of May. Antoine, can you remind us what are the scope and timeline for this?
Sure. So in terms of scope, it's rather easy. Every investment fund manager of a UCITS or an AF is in scope, regardless of whether they manage Article 8, Article 6, or Article 9. And obviously what you have to look at is the names of those funds to see if there is actually a big impact or not. In terms of the content of the guidelines themselves, we have a slide to show, and we actually also published a very comprehensive newsflash on our website, which highlights all the rules that are applicable. It's quite long, so we will not get into too much details. One of the key elements is the fact that if you are using ESG-related or sustainability-related terms in the name of your fund, you have to be at least 80% aligned with your characteristics. So we are looking at increase of alignment. And there is also this use of meaning. I mean, you have to have a meaningful portion of sustainable investment if you want to use sustainable in your name of your fund. And there are those PAB, CTB exclusions that apply depending on what type of term you use in the name of the fund. But please refer to that newsflash. It's much more detailed, and we will obviously share those slides, which are also a good summary of the rules. Now, in terms of timeline, which is obviously super important, it's not certain yet because so that the guidelines enter into force 3 months after all the translated versions have been published. So we have to wait for the guidelines to be published in all the EU member states' official languages. And so let's say it takes 6 to 8 weeks. So we are mid-July. This is the date of publication of the translations. Then we have to wait 3 months for the entry into force. So let's say mid-October. And so as of mid-October, every fund that is launched as of that date have to comply with the guidelines. For the existing fund, there is a bit more time because then we have 6 more months to comply with the guidelines. And this brings us to mid-April 2025. So for existing funds, we have quite a few months, but still there is potentially quite a lot of work. And another deadline that is mentioned in the guidelines is this 2 months deadline, which is the time for the NCA, so the CSSF, AMF, whatever, to confirm whether they want to apply or not the guidelines, sorry. And so this has to be done within the 2 months after the publication of the translations. But this is purely technical because we are pretty sure that the CSSF will endorse the guidelines. They've already published the communique, as you said. So they will probably adopt some sort of CSSF circular, which is going to confirm the application of the guidelines as they did for the performance fee and so on. So this is purely technical, but this means that everything depends on the publication of the translation, but it should be within the next months or so.
Okay, so I understand as for people to take away with some date in their mind.
Yeah.
So mid-October or something like that for the application if translation are done very quickly.
Exactly, for new funds.
And for new funds. And then you also mentioned the 2025 deadline.
Mid-April for existing funds.
Okay, thank you for that. So outside of the timeline, Valérian, we know that the market did not really receive this guideline well. I think there was a lot of debate, partly at FAMA level. I don't think this is a secret. There was a lot of discussion engaged by the asset management community on this final report. What are the main pain points for asset managers?
Yes, so if we really focus at UCITS funds and we focus on the three main aspects, I think the first one, which is the most obvious one, is the application of the PAB-CTB exclusions. So as Antoine mentioned, for any term that you will have in the name of the fund, in any ESG or sustainability related term, you will need to apply some exclusions. But the issue is that we don't know at this stage at which level those exclusions will need to be applied. So if you look at a very common UCITS funds and you're just investing in companies, then it's rather straightforward because you need to apply that on the entire fund, so on all the companies. But then there are some questions, notably for fund of funds, or just if funds are investing in some funds, if a look-through will need to be applied. Because of course, it makes sense to apply it and to perform a look-through. But if you're looking at a fund with multiple sub-funds, then it will become extremely challenging for the market to apply those exclusions to the underlying funds. And then we have similar questions, notably for derivatives, because if the underlying of a derivative is a single line or just a restricted basket of stocks, then potentially, yes, we could apply the exclusions. But now if you're looking at derivatives with indices as underlying, then it becomes, once again, extremely challenging to apply the exclusions. And so here what we see is that the market is trying to get a bit more flexibility on the approach that could be taken. So notably by either excluding some of the assets, like the derivatives, or potentially just have a bit more flexibility on the portion of the portfolio to which these exclusions will need to be applied. But again, it remains really early stage. And if you look at the guidelines, technically it should be applied on the entire portfolio and there should be no derogation. So this will need to be discussed a bit with each NCA and see if we can get some flexibility here and there depending on the expectations. The second point, I think, which is also roughly linked to the first one about exclusions to be applied, is a clarification in the guidelines in the form of a Q&A, which clarifies that the exclusions should apply at the level of the companies, regardless of how you get exposed to those companies. And this is especially concerning in the context of green bonds, because it means that, I'll take an example, if you take a green bond issued by Total Energy, even if the green bond is only financing wind turbines, because the green bond is issued by Total Energy, you will not be able to have that in the portfolio if you need to apply the PAB exclusions, which doesn't make any sense because as a reminder, you have some expectations from the European Commission, a definition of what's sustainable. And so you have new standards which are being developed at European level for green bonds. I don't want to get into the details, but basically it means that you would have bonds that are 100% sustainable, so 100% aligned with the EU taxonomy based on the criteria of the European Commission, so the greenest you can be. But because of those guidelines, you would still be required to exclude that bond from your portfolio. So of course, this is a huge concern from the market. And here we know that there are even industry groups like EFAMA that are intending to discuss or to send letters to the European Commission or ESMA and to try to discuss if this might not have been just an issue from the guidelines or something which have been missed from the drafting. But here, once again, very early stage. And if you look at the guidelines, they are rather strict on that. And the final point here, mostly about disclosure, so more for you. So I think it's the concern about the level of granularity at which market players are expected to disclose the information. Because the guidelines will tell you that you need to apply the PAB or the CTB exclusion, you know that you need to provide certain information, but it's not clear exactly if you will need to have everything at pre-contractual level, or if once again you can have a bit of flexibility on where exactly the information will be provided. And here, just once again to give one example, in Luxembourg, it's very common to have some of the exclusions at pre-contractual level, but to provide the thresholds used per sector in the website. But to be compliant with the PAB exclusions, you have to comply with specific thresholds, and it's not clear if these thresholds will now need to be disclosed in the PCD, so at pre-contractual level, or if this can remain in the website. And the issue here, which is more global, is that this will probably be left at the discretion of each NCA. So the first issue is that we don't have the answer now in Luxembourg, but also more generically, it's hard to know exactly what will be the approach of each NCA and if the approaches will be consistent. And so we have discussions notably with market players that would develop products in Luxembourg, but also in Ireland or in France, because potentially different NCAs will have different expectations, and market players, of course, they try to get a common approach for all their products. But if different NCAs have different expectations, then this will create first an uneven level playing field and also create discrepancies in the disclosures for products having the same approach, but just being launched in other jurisdictions, which do not make sense.
And so I believe that we have engaged with the regulator in Luxembourg to obtain some clarifications, and this is a process which is ongoing for now because it takes a bit of time. I mean, it's quite a massive piece, and to take position on this probably take a bit of time. Turning to you, Gaël, because we heard about from ourselves and as advisors, but so. Have you encountered some of the issues that were highlighted by Valérian just now?
Yeah, definitely. Those are real issues at the moment. But thankfully, we were revising at the same time our global sustainable investing framework. So, which means as soon as the consultation on ESG naming was out, we were already thinking of our product range, the name of our products, etc. So, which means that we are pretty advanced on our range of funds, on the strategy of the fund, the name of the funds. Now, which means more discussing the final details for the conclusion, but most importantly, focusing on the operations, the data feed for various exclusion for PAB, CTBs, and then some unclear elements of the regulation. So that's probably where we spend most of our time at the moment.
So it tied up with what Antoine was mentioning around trying to have products which are compliant, that you are ensure compliance with, and also what you were saying about investors not being quite sure about the product, and so looking at more clarification. So this is what you work with without waiting for this guideline to come out.
Exactly, but there are still some doubt, like meaningfully, what does it really mean? Those are difficult to translate into real operations, so we need more guidance on those guidelines.
Excellent. Well, I think it's fair to assume that that's still going to require a bit of work to be done. So again, hopefully the market's going to turn, and we're going to have some good incentives to work on this and change. I think partly for large fund asset manager, when you have multiple sub-funds, probably a bit more of an headache. I mean, moving on in terms of regulations and coming to local, I think one piece of the regulation that was long expected and that came out, and actually we had a webinar on this, the last one was on this, it's the new Circular 24856. I always need to look at my paper because we thought about 0277. I know, I don't think ESG was mentioned so clearly into this, but Antoine, I'd like to know what is the current position in that respect in the circular. So where do we stand with this?
So just to clarify, we're talking about the new 0277, which deals with NAV calculation errors and investment breaches, investment rules breaches. And so in that new circular, indeed, there is no mention of ESG, but it's saying basically that you have to comply with all your commitments, and it's a bit more broad. And so there are many reasons to think that ESG commitments are going to be caught by that circular. Many reasons why, because first, we had discussion with the CSF already, and those discussions led us to think even more that it would be applicable to ESG breaches. And we have also assisted many clients that have dealt with the CSSF directly, because CSF, for example, saw some discrepancies between annual reports and PCDs, so pre-contractual disclosures. And so they came to clients and said, well, we have seen those discrepancies. What happened? And why didn't you notify us under the 0277? So it was pretty clear at that time that they wanted to apply the circular. And so, yeah, the principle is there. It will probably apply. No, there are many, many questions. what is an ESG commitment, what is so binding that you have to apply the 277, I mean the new 277. But also, what do I do if I have a breach? Is it financial, non-financial remediation? And this should be addressed in an FAQ, in a Q&A, which is supposed to complete the circular. It has been confirmed by the CCSF that this FAQ will arrive, but we don't know how and when. So this is something we all wait for. But overall, the principle is that ESG breaches must be must be treated under the circular. And the big message we send to clients is that do something, review your policies and have this integrated somehow. And after the circular is published, then you can adapt yourself, but at least have something prepared and deal with those breaches under a certain policy so that you can justify it with the CCSF. If it's not under their own thinking of how it should be done, it's fine because there is no guidance for the moment, but at least know it's coming, so be prepared. That's the message.
So Gaël, I don't want to put you on the spot here, but because we gave the advice to our client, how was this received and what is your feeling about this circular?
I concur. I mean, from an ESG point of view, the new circular, I don't think it's very clear. I just await the guidance to be issued on the FAQ because I have so many questions. But now that I said that, I mean, we set up our ESG limits, such as minimum percentage of sustainable investment as a regular limit. So there is the full process behind. So we feel okay, but we just wait that FAQ to confirm that what we've put in operation is actually correct.
Thank you. So that was 2456. There's another piece of regulations which were already into place where we also saw some of our clients having an interest, and it's the revamp of the SFDR level 2. And Valérian, I'd like you to say a word maybe about this. Where do we stand with this review?
Yes, so as a reminder, indeed, we have the current RTS with the expectations that you all know about the templates that are currently existing. For the people listening to us that worked on that, you know what I'm talking about. And so there are some discussions at European level with new RTS with the expectation to revise once again SFDR. I don't want to go into the details, but so there are changes notably on the PAIs, on the expectation in terms of disclosures. But I think the main concern for the market is really that there will be an entire new template. So for all Article 8 and 9 products, there is an expectation to complete a dedicated annex and to put it a template and to attach it as an annex to the prospectus. And so for market players like Fidelity, we're talking about close than 1,000 pages per fund. So if you combine all the funds together, it's several thousand pages in some cases. It's huge. And so here, initially, the RTS, they were expected to be endorsed by the European Commission by end of March. But then we all know what happened and they had a backlog. So this is going to be for the next commission. Now we expect this to enter into force by the end of next year. And so here, again, if I really want to focus on the key aspect is that each Article 8 and 9 product on the market will need to amend the existing annex that they currently have in the prospectus. So for each Article 8 and 9 product. And so when you have more than 1,000 pages of documents to update, this will be significant. Now, to be reassuring, there are several elements to mention is that if you look at that PCD, at the end of the day, you could split it in two sections. You first have the four first pages of the template, which are closely aligned with what we currently have. So it's basically a sort of summary, although it was 5 pages long, now it's 4 pages long. So it's 20% shorter. It's 20% less, yeah. So it's 20% less, and they try to simplify it as much as possible the terms. So it should be more digestible for investors, hopefully. And so the work that has already been done will simply be about transferring and reshuffling what we already have to plug it in the new template. Now, the issue is for funds or for market players having greenhouse gas emission as an objective for their products, because then you have a new section which is 2 pages long. So at the end, the new template is even longer than the previous one. But in the new template, you have a dedicated section for this to be completed only if you have greenhouse gas emission reduction targets. And in that case, of course, there will be work on that specific part. But that's 2 pages, and that's for some sub-funds only. For the rest, so the 4 pages, of course, if you talk about 100 sub-funds, that's again a lot of pages to produce. But again, on a positive note, the market is now more prepared than before, because in 2022, everything had to be done manually on Words. And for those who knows, once again, this template, you have all these gray boxes everywhere, which makes it challenging from a formatting point of view, which led to a lot of issues with those big documents. But now we just have more stable versions of these templates, and there are also a lot of tools which have been developed. Actually, here at Arendt, we do have a tool which allows to produce all those documents, so at pre-contractual level, websites, and in the annual reports. So it really facilitates a bit the production process of all these documents. And so I suspect that even if there is a lot of work that is coming, it should be a bit simpler than what we had end of 2022.
Operationally
speaking,
it's going to be a bit more, hopefully. You said it, if it comes, I mean, obviously, so we one day after the European vote, it's not our place here to comment on the elections results, but I think it's fair to say that, people that were very much in favor of all these changes have probably lost some seats. And so, maybe I'm going to turn to the lawyer in the room, Antoine. It's like, any risk of, postponement? Indeed, that's going to be the role of these new commissions to take decisions.
As you said, it's a commission delegated regulation, so it comes from the commission. So I'm not an expert in politics, so I don't know their priorities. But in theory, the RTSs are developed by ESMA, but then they have to be endorsed by the European Commission. And so if they want to focus on something else, or if their priorities have changed, or if they don't like it anymore, even though we heard indeed that it was supposed to be endorsed, but if they don't like it anymore, they could potentially push it back. Also, we hear that there might be also a more important focus on SFDR level 1 reshaping, but this is still unclear at this stage. But yeah, in theory, it could be postponed.
Okay. I think, obviously, again, we don't have a crystal ball and we don't know what's going to happen, but I think it'd be very important to monitor this because, there's been a lot of commitment, a lot of engagement from the asset manager community. And, as we discussed today, there's probably some flaws and things to be revisited, but, as we step in that direction, it'd be good to continue the momentum. I think, at least for me, I think it's good for the planet also, because we should not forget that these funds should finance, project that, will help us in our 2050 objective. Not a regulation yet, but I think a document that is of interest and effectively is kind of, giving some views in terms of where the supervisory authority wants to be. The report on greenwashing, I think, Valérian, if we can take a few minutes to talk about what are the main findings, if any, or any new stuff.
Yeah, so the final report on greenwashing, which has been published last week, just as a reminder, it follows up on the progress report, which was published a year ago, so in May 2023. And if we start with the progress report, it will be important for after. So in the progress report, ESMA and the ESAs in general, but if we focus on the investment, so in our industry here. Yeah. So if we focus on our industry, the progress report already provided a lot of details and information on their expectations with additional guidance on what could be considered as greenwashing, how this could be avoided, with practical guidance in terms of disclosures and specific expectations. There was one which we use a lot, which we like when we talk about sustainable development goals, which is the case of most market players today. In the progress report, for instance, they provided examples of elements that could be provided to be considered as sufficiently described. Because today it's rather high level or vague, the information provided. So in the progress report, they provided more information, but it was just a draft. And in the final report published last week, the expectation, at least on our side initially, was that they would provide further guidance on all these aspects. But if you look at the final report, it's mostly a repository of everything that has already been done by the European authorities to combat greenwashing. So they provide a lot of information on what has already been done at local level, at European level, by the European Commission, so by all the entities and by all the stakeholders on the market. But they don't provide a lot of guidelines on what exactly should be done to avoid greenwashing. The elements that are worth to be mentioned. The first one is that they invite market players to have a look at the progress report. So initially we anticipated that it was just a draft and then they would confirm or just change some elements, but they didn't. They just say, look at the progress report and take that into account. The second thing is that they confirm that greenwashing can occur intentionally or unintentionally, although there was a lot of pushback from the market because, of course, if it's not not really your fault, you want to say that you cannot be accused of that, but you can. The third one is that they provided to NCAs a full annex with all the legal references that could be used to enforce greenwashing. To enforce greenwashing, meaning that to sanction on greenwashing elements, which did not exist until now. And then a last point maybe on that is they talk about the CSA. So there is a common supervisory action at the moment happening at European level, and they talk about it and they clarify that the final report is expected to be published by the end of the year. And they also provide a bit of clarification on the findings. And they say basically that they found out that there were some room for improvement.
The usual.
So,
but I think it's and again it's an all regulation, but and maybe it's because being in a law firm we are more associated to this kind of risk. But I mean, clearly the greenwashing risk and investor complaints, in relation with your policy, and we mentioned it before. Like sometimes it's confusing, it's super elaborated, and we have, as we talked about, some issue with the performance. I mean, I'm sure, like for asset manager, that risk of greenwash is probably quite high up on the agenda. Is that the case also?
Yeah, it's basically on all the boards. We mentioned that, but it's operationally it's hard to do, especially to anticipate all the unintended cases that are in the progress report.
So again, something I think to be followed up for the future, and see how this is evolving from I would say a sanctions point of view, and also.
No, but if I may just also, because we always talk about greenwashing as a sanction, because indeed they are providing some list of potential sanction or sources basis for sanctions. But we have to also keep in mind the contractual aspect of those commitments. So if you sell something to a client and you commit to something, you are, depending on how you word it, so this is also something lawyers are looking at. But if you commit to something and then you don't achieve that, well, you have a civil liability towards your investors. And we're not seeing it a lot, but we could at some point. And so there's a lot of work to do. But when we talk about simplification before, you talked about it, I talked about it, there is also something about not committing too much from a contractual standpoint, but at the same time, this goes in the other direction than the regulation themselves. So there is, both indeed NCAs, but also investors directly from a contractual standpoint to bear in mind.
Yeah, the litigation potential is actually quite big. That's for sure. Right. There is a final piece of legislation I'd like to talk to, and I think that's going to be mostly for you. So on January 1st, 2024, the Corporate Sustainability Reporting Directive came out, CSRD, and that was followed up by the European Sustainability Reporting Standards. With I would say the first visible effects will be 2025, and obviously. I mean, in Luxembourg, looking at our clients, generally in size, and we felt that most of them would be out of scope. But looking at the size of your organizations, I suppose that this is also a topic for you, and would like to.
It's actually a pretty strategic project. We have multiple entities in scope, so we need to think about how we will report. Do we report locally at those entity level, or we do a regional report, or even a global report? Because in most of our countries where we are, we will also be impacted by SSB. And there are some common elements that we need to do. Plus, CSRD is an assessment of the value chain. So in any case, it asks for transparency of all our markets. So it's hard to do. a lot focusing on how we report finally, and most of it, how do we capture all the data so that we can report it safely. It's a big project to make it happen.
So that's something where Fidelity is fully engaged for now. That would be your advice to although this is a 2025 and maybe further on target, to engage right now.
You better start right now. Yes,
right,
there are plenty of questions.
I think indeed we see quite a lot of questions around scoping and scope or not, and the question of indeed whether you need to report locally or where you can rely on the group reporting is something that is pretty much in the mind of everyone. But the second piece probably not as much advanced as it should be. Again, I think some people consider it's still quite a long time.
Yeah, I think even if you are not in the scope per se, there will be some interactions with other people that are in scope. So even if you are not in the scope, if you are a small asset manager, have a look, because you might receive some questions from investors, from other contractual people you work with. So definitely have a look.
Yeah, that's a very good point. Well, thank you for that. Thank you, gentlemen, for your time. We still have a few minutes ahead of us, so we can actually look at some of the potentially questions that we had, and one that seems to come is around. Well, I think you mentioned it. And it's coming back. It's on the meaningful, and so maybe for Valérian. Difficult task, but what meaningful means?
Yeah, good question. I wish I knew. So we have the discussion with most of our clients at the moment, because indeed it's completely left at the discretion of each NCA. If we try to find some guidance, we need to go back to the consultation paper, really the draft, because as a reminder, in the initial consultation paper, so the first paper that set a bit the rules or the expectations for those guidelines, initially, we didn't have a meaningful definition, or we didn't have a reference to meaningful. We had the 50% threshold being set. Then, of course, there was a lot of pushbacks on the market for that 50% threshold, because this is based on the share of system investments, and depending on each market player definition and ambition of what is considered as sustainable, setting a 50% threshold would not be fair for all market players. And so this has been understood by ESMA. So they removed that 50% threshold and they left it with nothing, just with the meaningful. And so, of course, now we need to discuss this with each national competent authority on what would be their interpretation of meaningful. What I can tell you is that when we discuss this with our clients, something that, in our opinion, makes a lot of sense as an approach is to work on the basis of a sort of a comply or explain basis, where if you have more than 50% of system investments, then you would be on the safe side, because it's in line with the draft. And then I think generally speaking, if you have 50% or more of system investments, it's clear that it would be considered as meaningful. Now the question is for funds which have less than 50% of system investments, and then you would fall in the comply basis. And so here, in our opinion, this should be something that has to be discussed with each national competent authority. And here we cannot provide a strict threshold, but again, if you're really looking for thresholds, something that could be used, something that we see a lot is the 35% threshold. And actually, ALFI in Luxembourg, they already drafted. So when they drafted their answer to the consultation paper, they were against that 50% threshold. And in their answer, they already mentioned that for them, 50% might not be relevant. And they were considering that a threshold around 30 to 35% could be considered as meaningful, depending on the investment universe. If you're investing in small caps or in emerging markets or small cap emerging markets, then you have less data, and generally the investment universe of these funds, they have less system investments. So there it would make sense to have lower thresholds. Or another very common reason is if you have a fund which are highly exposed to sovereigns, because a vast majority of the market, they exclude sovereigns from their system investment framework, which means that a significant portion of their portfolio cannot qualify as system investment. And so here it would make sense to look at the rest of the portfolio to be able to say that it's meaningful, reducing the threshold from 50 to something lower being to be discussed.
Thank you. Hopefully it does provide clarifications. Another question, I think we talked about the the legislative process or at least what's happening at the European Commission. And there's a question about, okay, how does that fit with like a trend that we see globally around ESG regulation? And again, I think as you are covering ESG for Fidelity worldwide, what is your view on that one? How does that fit with, what do you see worldwide happening?
We could see that the big trend is led by the EU, then closely followed by the UK, and then all the APAC, the Asia Pacific is basically mimicking what Europe is doing. Where we have a little uncertainty at the moment is the US because there is a anti-ESG movement that we should not underestimate. So basically, what we think is we focus on the EU regulations and that becomes the gold standard globally, and then we can choose what happens in those particularly location.
And maybe a follow-up question on that is, so with all these ESG regulations popping out and and being a global organization, how do you manage that efficiently? I mean, you said that you are the gold standard, but what is your, I mean, you don't have to give all the recipe, but what would be the approach?
Well, I think there is ESG regulation everywhere, and they are a bit conflicting to each other depending on the countries. So what we try to do is think holistically what a good ESG methodology is, regardless of a regulation, and then the various products that we want to perceive, to create based on that. And then based on that, we add the local layer, but focus first on what ESG methodology means. Is it meaningful, basically?
Okay, thank you for that. Maybe one last question, and we come back to the local market. I'm going to turn to you, Antoine, and again, hopefully not putting you on the spot for that, but there are some questions about are we going to have a CSF fast track approach on the implementation of the fund names regulations?
I don't know. That's the first answer, because I know since we had one fast track, everybody wants fast tracks all the time. But so what we know is only based on informal discussion we have with case officers we meet or we have on files, is that it's not planned for the moment. And why is that? First, because there is a lot of time. Let's be honest, we have 9 months before the entry into force for existing funds, so we have time to work on it, to put it into existing projects. Like you said, with Fidelity, we're working on all the topics you implemented at the same time. So there is time. There is no pressure, and it's really also, I think, a case-by-case analysis. Whereas when it was for SFDR level 2, it was one template, and they said, well, we will look at it a bit later. Here, it depends so much on what you do, what you disclose, what's your name, obviously. So I don't think it's really feasible. And there is a bit less volume, of course, because it's only for funds which are using ESG-related names. We are seeing actually marketplaces that are removing those ESG-related terms to avoid all those rules. So I think not, but I don't have the crystal ball as usual. And it appears not to be planned by the CSSF, but maybe they will realize it. What we are aware of is that they take it very seriously. They have already looked at it pretty intensively. They are mapping already on their side funds which have names which could fall into the scope. And so they clearly invite every fund manager to do the same exercise in advance. So we have all summer to do that. We can look at our funds. Identification, whether you are impacted or not, it's quite easy. You look at the name of the fund. There are some cases where you can discuss, is it ESG related or not, but most of the time it's pretty clear. So the scope itself, it's easy, and then you have to decide on your own whether you apply the rules or you rename your funds. And so, yeah, such a case-by-case analysis that I don't think the CSF will put a fast track into place. And it's at the end only renaming of changing an investment policy. So it's a very usual process to follow.
Thank you. Well, we'll see, but as you said, I think there's so many components that probably it's a bit harder for and they have all the information because they gone through this data collection exercise. So now they should have all the information they need to make up their mind. Gentlemen, thank you very much for these conversations today. You invite the audience to stay tuned for our next webinar. And again, thank you very much, and have all a very good day.